kind of property because of damage caused to any kind of health or assets of a person, for that we take up something called as non-life insurance. Now, whenever we are talking about non-life insurance, we have several types of non-life insurance contracts. Like we have fire insurance, we have marine insurance, we have automobile insurance, we have something called as health insurance, we have something called as tourism insurance. All these insurances come under non-life insurance contracts. Now, just like banks are regulated by Reserve Bank of India, insurance industry is also regulated by something called as IRDA, which stands for Insurance Regulatory and Development Authority. Now, whenever we are talking about IRDA, IRDA is an apex body, right? Whether it is, whenever we are talking about life insurance or non-life insurance, both this life and non-life insurance contracts are regulated by Insurance Regulatory and Development Authority of India. It is the supervisory body which takes care of the complete regulation of insurance sector in the country. It sees that the functioning of insurance regulatory will work out properly, and it sets certain rules and regulations for the proper functioning of insurance industry. The main reason for the establishment of IRDA was to protect the interest of policyholders and to develop or create awareness about insurance among the investors. Now, before the establishment of IRDA, Government of India was the regulator of insurance industry. But however, after the establishment of IRDA in the year 2000, right, this IRDA is a body which was established under the recommendations of the Malhotra Committee in the year 1999. So Malhotra Committee was set up to give recommendations about how to regulate the insurance sector in the country, for which they come up with the recommendations that there should be some apex body or there should be some supervisory body which would be regulating the insurance business in the country, which gave rise to the formation or implementation of IRDA. Now, IRDA has outlined certain rules, regulations, right, pertaining to insurance contract. These regulations include what do you call as registration of insurance companies, protecting the interest of the policyholders, right? And whatever is required in order to develop or whatever is required in order to create awareness among insurance sector, all those rules and regulations are framed under IRDA. Now, whenever we are talking about IRDA, there are 34 general insurance companies and there are 24 life insurance companies which are registered with IRDA, right, in terms of regulating the IRDA business. Now, whenever we talk about IRDA, IRDA plays a very significant role in insurance sector, right? It plays a very important role which emphasizes the importance of policyholders and their interest. Now, what are the main functions of IRDA are? They protect the interest of the policyholders. See, policyholders take up the insurance policies in order to get the benefit in case of unforeseen situations. So it is IRDA, which is a regulatory body which checks whether the policyholders are getting their claims or not, whether the policyholders are interest is protected or not. That is the main function of IRDA, to help the speeding up of growth in insurance industry in an orderly manner. That is, they make sure that everybody in the country are covering the insurance or everybody in the country are taking up health, life and property insurances on their names so that they can be protected. They will also make sure that there is a growth of insurance industry also in the country, right? They provide long-term funds to speed up the nation's economy. See, Indian economy or any country's economy is made up of different types of financial regulations, different types of financial instruments or different types of financial services. So, insurance is also one of the service which can help towards the economic development of a country. So, they make sure that through insurance, country's economy will also develop. Not only that, to promote, set and enforce and monitor high standards of integrity, fair dealing, financial soundness and competency of the insurance providers. See, they make sure that whatever insurance companies are providing you insurance policies, they have financial soundness and they deal in a fair and just manner. They are trustworthy and they're competent enough to do such kind of business. Only those things are encouraged under IRDA. Not only that, they make sure that if the claims are genuine, they make sure that if the person is asking for a claim, they are settled faster and efficiently, right? Only in case of genuine claims. They will also make sure that any grievance that a policy holder has, see, if you have any grievance in normal courts, in the normal context, you will go to the normal high courts or what do you call as district courts or superior courts. But whenever there is certain fraudulent activity, or whenever there is some grievance that you have relating to insurance, you will go to something called as IRDA, who will protect the interest of the policyholders. They will also make sure that whatever insurance contracts are there, or whatever insurance markets are there, they are promoted in a transparent, fair and systematic order. They must make sure that everything happens in a transparent way. They must make sure that everything happens in a systematic manner. Not only that, they would build a dependable management system to maintain high standards of financial stability, right? Financial stability is also should also be followed by insurers in order to give up the claim, or in order to give up the financial sector. So that is made sure under IRDA. They make sure that whenever standards are not maintained, IRDA will take up an appropriate action. See, insurance companies have to make sure that they maintain the standards. If they are not maintaining so, whatever necessary action is required, that is taken care of. And they also make sure that there is proper self-regulation in the industry. That is, the insurance companies are self-regulated by themselves. So the IRDA takes care of regulatory functions. IRDA takes care of developmental functions. IRDA takes care of promotional functions, and IRDA also takes care of policy holders related functions when it comes to insurance sector. Now, after IRDA, the next thing is financial inclusion. See, whenever we are talking about financial inclusion is something, right? It talks about those efforts which are made to make the financial products and services available to everybody in an affordable manner. See, whenever you're talking about financial inclusion, it tries to remove the barriers, right? Exclude people from participating in financial sector. See, there are some barriers which stop people. See, for example, uh, illiteracy, digital financial illiteracy. If people are not aware about the financial opportunities, or if people are not aware about the financial avenues, they can never invest in financial markets, or they can never invest in financial sector. So this financial inclusion tries to remove all those barriers so that people can participate in financial sector and their lives can improve. Now, whenever we are talking about financial inclusion is described as, right? It is a process, it is a way, it is an effort of offering something called as banking services, financial services to every individual in the society without any discrimination on the basis of class, gender, age, anything like that. So, whenever we are talking about financial inclusion, we are talking about those strategies, right, which are offering banking and what do you call as financial services to individuals, right, including everybody without any kind of discrimination, right? So what are you doing under financial inclusion? It is described as the provision of savings and long services to poor also, which are inexpensive and easy to be used. Now, whenever we are talking about financial services, financial inclusion is very, very important, because poor households in India do not have any kind of access to financial services in the country. They are not even aware about the banks. They are not even aware about the functions of the bank. Even if they are aware of the banks, there are many people who do not have direct access to banking services, right? They don't meet the minimum eligibility criteria which are laid down by the bank, right, in order to get the services. So, for that reason, financial inclusion is very, very important in order to have including people of economically underprivilegedly people with underprivileged background, people with economically weaker sections, in order to make sure that they are also involved in financial inclusion. It is very, very important to understand that financial inclusion is important. Now, financial inclusion aims, what is the main purpose of financial inclusion is, financial inclusion aims at eliminating all the barriers, right, it aims at eliminating all the barriers that stop people from participating in financial sector, or that stop people from participating in financial industries. Now, what are the reasons or what are the causes of financial exclusion? See, I told you the major cause for financial exclusion, why people are not included or why people are not participating in financial sector, is lack of financial access. See, there are wide range of services. There are wide range of credits for household and enterprises, but people don't have access to that, right? So there is an evidence that though access is improving, but still there are multiple factors, right, which are affecting the access to financial services. Now, what are the reasons for financial exclusion is, the first reason for financial exclusion is low income and nature of occupation. See, whenever people have low income, people are completely financially excluded, right? See, people will get included into the financial sector. People will participate in financial activities only when their income level is high, right? If their income level is low, people can never participate in main street banking, or people have less interest towards participating in banking. And the nature of occupation also, see, it is important factor in availing what you call as financial services. Whether you are a small scale, large scale, organized or unorganized firm, all these things have a greater impact on financial inclusion. So if your occupation is unorganized, you can never be included into the financial sector. Not only that, social exclusion and lack of identity. Social exclusion is also a very common cause for financial exclusion. That is, people who are unemployed, people who are financially dependent on other, people who don't have any credit history in the place, are people who are excluded from the financial markets due to social status. So, social status or people who don't have identity are not included into financial sector. Place of living is also very, very important. Are you living in rural area? Are you living in an urban area? What is the kind of physical infrastructure facilities that you have? Density of population, mobility of population, all these things play a very important role. All these things play a very major role in financial exclusion. Level of income and bank charges, also people's standard of living, right? What is the earning capability of the people? What is the earning capacity of a people? All these play a very important role, and the hidden charges of a bank are also are also demotivating the poor people from being financially included into the sector. So this is also one of the major reasons for financial exclusion. Lack of proper ecosystem. See, even though there is no shortage of financial products and services, right, which can help the low income people, but there is lack of sufficient distribution channels. Villagers end up in long queues. They don't know how to use the ATM cards. They run out of the cash. They break down. See, there is no proper system. There is no proper ecosystem which is helping out people in order to be financially included into the market. That is one reason. Rigid terms and conditions. The terms and conditions are not flexible. They are rigid. Though people are interested in financial products and services, but because of this rigid terms and conditions, people are unable to participate in financial markets or financial sector. Not only that, loss of wages, right? The working hours are same as the working hours of, see, bank working hours or in our working hours are same as each other. So it acts as a barrier to financial inclusion, because people cannot leave their work and go to bank, travel long distances, right? Because they will lose their daily wage. So that is one of the reason for financial exclusion. And apart from that, self exclusion. See, when you are seeing into the recent times, there is an increase in bank accounts, but consumers are not using them, right? So not only creating products and engagement strategies, but there should be needs of consumers which must be ensured are fulfilled. So all this turn out as the uh, causes or reasons for financial exclusion. But there are a lot of advantages of financial exclusion. What are the advantages of financial exclusion are? See, The advantages or the benefits that you receive out of financial inclusion are divided into three categories: benefits to users, there's something called as benefits to bankers, benefits to government, and benefits to economy as a whole. Now, whenever we are talking about benefits to users, see, financial inclusion gives access to insurance, which will protect your unexpected emergencies or which are unexpected losses, right? They help you in getting out of the clutches of money lenders. See, previously we had pawnbrokers, we had money lenders who charged a very high rate of interest. But now, because of the inclusion, financial inclusion, you are out of that money lenders. Not only that, they will receive social security transfer systems. Like if you are included financially, you will receive pensions, you will receive monthly pensions for widows, monthly pensions for handicrafts, which government directly puts into the bank's account of the individual. So if you don't have a bank account, if you're not included into the financial sector, you can never avail this financial benefits. Not only that, it will help you in enabling your economic independency. It will support the economic or improve the economic well-being. Not only that, it gives you easy access to loans, insurance, money transfer, and overdraft facilities. See, if you have a bank account, you can easily get up a loan. If you have a bank account, you can transfer money from one person to the other person, or you can go for overdraft limits if you don't have money in hand. So these are the benefits that a user has. Apart from that, we have the benefits that a banker has. See, whenever we are talking about the benefits that a banker gets out of financial inclusion is, see, the people who are at the bottom of the economic stratas, right, are many. If they are not included into the financial sector, right, the numbers will be very huge. That means customers are huge. If they don't save their money, they might be at loss. So when these huge money is collected, it can be used for the economic development. It can be used. It creates a kind of business to the banks also, right? Not only that, low cost deposits will be offered, right, which can increase the profits of the bank in long run. Huge opportunity for banks to cross sell the products, right? Today, I told you banks are even selling something called as an insurance product, which is called as bank assurance. They are involving themselves into that also. And sorry, increased use of banking infrastructure also. Financial inclusion helps in increased use of banking sector, right? Not only that, it is beneficial to the government also. Financial inclusion will help the state and central government in many possible ways. For example, it removes inefficiency from the system. People should be capable enough of going to bank. People should be capable enough of taking up an insurance policy on their name. People should be capable enough of doing or participating in the financial market. So that is only possible because of financial inclusion, right? Possibility of making social security transfers. I told you, widow pensions, handicapped pensions, age-old pensions are directly transferred to the bank. So it will benefit the government to make sure that things are going into the right person's account, right? This will minimize the transactional cost. Not only that, they will also plunging leakage in distribution network also, right? Not only that, financial inclusion has benefits to the economy as a whole also, right? It would lead to a large number of benefits to the society also. For example, it brings additional savings into a formal financial channel. Not only that, higher income coupled, right, there is a probability of higher incomes being coupled up with the reduction in cost economy. There is a possibility of tracking individuals' financial status, whether the consumer is utilizing the protection mechanism properly or not, that can be checked. And there would be a high level of financial literacy, which is very, very important to participate in financial markets or financial sector. But there are a lot of challenges faced by financial inclusion. Now, what are these challenges are? See, whenever we are talking about the challenges that are faced by financial inclusion, these challenges, despite various measures are taken, right, there are a lot of challenges that are faced by the stakeholders while strengthening the financial inclusion in the country. The first important challenge that the financial inclusion faces is inadequate infrastructure. there is lack of proper physical infrastructure, there is lack of transportation facility, there is lack of trained staff, right? In many parts of rural areas or far off areas, which is a barrier to financial inclusion. And poor connectivity. Today, I told you we are living in a technology driven era and everything is technology based. Your door to door step banking, internet banking, mobile banking, telephone banking, right? ATMs, what do you call as core banking solutions, all of them are technology enabled. And for that, connectivity plays a very important role. But with technology being important enabler to financial services, certain regions in the country have poor connectivity, right? Which is leaving behind the financial inclusion in those kind of areas or in those kind of sectors. Convenience and relevance. There are some complicated procedures which are difficult. There are some irrelevant requirements which makes the customer far away from financial inclusion. Not only that, there are some socio-cultural barriers, there are some societal norms, there are some cultural barriers like women cannot, don't have the freedom to choose the financial services that they want. Apart from that, there is a system, there is a section of people, right, who believe that there are some social barriers which prevent them from entering into financial markets. Not only that, product usage, uh, financial inclusion has resulted into microfinance and pension schemes and things like that. So the product usage is also one of the biggest challenge with financial inclusion. All these turn out to be the various barriers for or the various challenges for financial inclusion. Now, whenever we are talking about financial services, one of the important service that a financial sector gives us is merchant banking, right? Now, when we are talking about merchant banking is used for strengthening the economic development of a country because they act as a channels to raise funds or for disseminating the information to companies. See, whenever we are talking about merchant banking services are very important because they was a they are the markets where companies go for new issues. So merchant banking activities are organized and undertaken in several forms, which are very, very important for a country's development. Now, what is merchant banking is? A merchant banking is defined as an organization or a service that acts as an intermediary between issuers and ultimate purchasers of securities in the primary security market. See, we have learned, we have something called as primary market and we have something called as a secondary market. Primary market is a market where securities are traded first, right? They don't have what you call as exchanges. It is direct dealing between a company and a investor. So merchant bankings are those activities, merchant bankings are those organizations which act as an intermediary between issuers and purchasers. Now, whenever we are talking about the merchant banker, it is an institution that helps companies to raise capital, right? They are the people who helps the company to raise money, right? It is an organization which writes corporate securities and provides advisory services to its clients. See, a new startup company wants to go for an issue of shares or wants to go for an issue of IPOs. Merchant bankers are the people who help them out. Merchant bankers are the institutions or organizations who will help in underwriting those securities and also provide advisory services to their clients. Now, whenever we are talking about merchant banking is called with different functions in different countries, right? It is referred to as an institution which conducts underwriting, loan services, financial advisory, and fundraising services to what do you call as multinational corporations or large corporations, because they are an experts in international trade. They are a specialist while dealing with multinational companies. So, unlike retail bankers, merchant bankers do not provide normal financial services to general public. They provide merchant banking services to large business corporations, right? So that they can help, merchant bankers can help them in raising funds or in raising the capital. Now, whenever we are talking about the concept of merchant banking is very, very important, right? Why is it important? Because it plays a very important role in the economy. They offer financial services. They offer financial advice and provide solution for both small and big firms, right? Which will help in economic development of the country. Now, there are some important fee-based and fund-based functions that a merchant banking follows. For example, raising finance for clients. They raise finance through issue of shares, debentures, and bank loans. Not only that, they not only raise money for domestic markets, but they also raise money from international markets also, right? They use these funds, right, in order to they use the funds collected, right, for starting up a new business houses or to start up a new project or modernization and expansion of already existing business activities. They also offer something called as brokerage in stock exchanges, right? This is also one of the important functions of merchant banking. See, as merchant bankers, right, are an intermediary party, they act as a broker in stock exchanges. They buy and sell shares on behalf of their customers or on behalf of their clients, which is an important function of merchant banking. They buy, they sell shares which are important for their clients, which will benefit their clients. They purchase and sell all those shares, so they act as a broker in stock exchanges. They help in project management. They help in choosing a project, locating a project, preparing a project report. They conduct something called as feasibility studies. They do a financial planning for a project, right? Not only that, they help you in getting success, what do you call as subsidies. They help you in getting something called as incentives, incentives from the government also. Not only that, they give you advice on expansion and modernization of your business also. See, merchant banking not only helps you in raising funds, they give you professional advices, right? How to expand your business operations, how to modernize your business operations, like using some techniques called as mergers and acquisitions, amalgamations, takeovers, joint ventures, strategic alliances. All these things, all these technical advices can be given by the merchant bankers. Not only that, they manage, right, public issuing. That is, they make sure that they manage the public issue of shares and other financial intermediaries and provide services with regard to timing of public issue. When should you go for a public issue? What should be the size of the issue? What should be the price of the issue, right? How can you underwrite and broke to an issue? All these things are shared under merchant banking. Not only that, they serve to public sector units also. They not only provide the services to banks and other corporate sector, they provide the financial services advisors to banks also, right? People think merchant banking is a complicated thing, but merchant banking, right, has different types. See, whenever you're talking about SEBI, Securities Exchange Board of India, it defines merchant banking as any person or an institution who is engaged in the business of issue management. That is, you are issuing by making arrangements of either selling, buying, or subscribing to the securities, where you are acting as a manager, consultant, advisor, and rendering corporate advice. Such kind of issue management is called as merchant banking. Now, merchant banking has four major categories, right? The classification is given like this. See, if you're talking about category 1, what activities will performed by the merchant bankers is issue manager. They can act as an issue manager, they can act as an advisor, they can act as a consultant, they can act as an underwriter, or they can act as a portfolio manager, right? For how many, the worth of that issue should be minimum 5 crores. So if your issue is minimum 5 crores, you can act as an issue manager, advisor, consultant, underwriter, portfolio manager. But if your issue is 50 crores, you come into category, 50 lakhs, you come into category 2, where you can act as an advisor, consultant, and underwriter, or a portfolio manager. If your issue is less than 20 lakhs, you come into category 3, where you can play the role of advisor, consultant, and underwriter. And if your category is 4, right, minimum net worth is not required, where you can act as an advisor or consultant. Now, whenever you're talking about merchant banking, people assume merchant banking and investment banking is one and the same. But there are some differences, right? It is actually misconstructed as similar, but they are different. For example, merchant banks are those banks which will try to fulfill the capital requirements of a company in the form of ownership. Whereas investment banks are financial institutions that will help individuals, government, or corporations in raising financial capital by acting as an intermediary. See, the major focus of merchant banking is on small banks or small companies, whereas investment bankers or investment bank, the major focus is on large companies. Now, the kind of services that are provided under merchant bank is it provides banking, advisory, and custodial services. Whereas in investment banking, they provide banking and advisory services and earn income from interest or lease rentals. When it comes to merchant banking is fee based, whereas investment banking is fee and fund based. When it comes to merchant banking also deals with international financial activities also, whereas investment banking only deals with underwriting, issuance, and of securities. But there is it provides to clients. Merchant banking usually provides to clients or individuals, whereas investment banking is provided rarely to clients. Their major concentration is on the companies. Now, underwriting of new shares, management of securities, portfolio management, project promotion, corporate counseling. These are the major activities performed by merchant bankers, whereas investment bankers only provide underwriting of shares, bonds, and advisory service of mergers and acquisitions. So, people are under the assumption that merchant banking and investment banking is one and the same, but there are two different things. There are some activities which are what do you call as overlapping in both merchant and investment banking, but investment banking and merchant banking are not same. Now, what services are provided under merchant banking is merchant banking provides 4 different types of services. One is initial public offering, follow-on public offering, private placement, and offer for sale. Now, what is initial public offering is, see, merchant banking responsibility is when they compare the traditional role of managing and underwriting in IPO, today's merchant banking merchant bankers role is much, much higher than what it was traditionally. They have a responsibility of ensuring that it includes in the market making for a period of more than 3 years from the IPOs. So, initial public offering is the first service. They act as an intermediary parties for issue of what do you call as shares, right? As follow-on public offer, in case of this, the shares are issued after the company is listed, right? In addition to IPO or initial public offering. Not only that, in private placement, the sale of stock, bonds, or securities are directly done to private investors. The securities in this case are not meant for general public. They're mostly small number of chosen investors like family, friends, or investors. And in offer for sale, it is a mechanism where promoters in a listed company sell their shares to public in a transparent manner. So all these are the services which are provided by the merchant bankers, right, under 3 categories or under 3 what do you call as levels of services. Now, whenever we are talking about merchant banking, right, merchant banking is one of the important merchant banking has a very important role in merchant banking has a very important role in economic development of a country, because they are the people who act as an intermediary party which help in raising of capital, which help in capital formation from the primary market. Next comes mutual funds. One of the financial service which is provided is mutual funds. That is a mutual, it is, whenever you're talking about a mutual fund, it is a type of financial device, it is a type of financial vehicle which is made up of a pool of money collected from investors to invest in different securities like stock, bonds, money market instruments, or other assets, right, according to each fund's objective, right? Whenever we are talking about mutual funds are financial devices, mutual funds are financial instruments, right, which pool money from a large number of investors who have a common investment objective. The money which is then invested in equities, bonds, money markets, and other securities. But mutual markets are considered to be very special because they denote or they show a financial instrument, as well as they can be shown as a financial instruments or as a financial institutions also. So mutual funds are becoming very important these days. Mutual funds are becoming very popular these days. See, whenever we are talking about mutual funds, the fund is managed by a professional manager who is called as a fund manager, and the returns obtained are distributed among the investors. So mutual funds have a very special place in the financial markets. Now whenever you are talking about mutual funds have a lot of advantages and disadvantages, right? This is how a structure of mutual funds look like. One second. This is how a structure of mutual funds look like in the financial sector. How mutual funds look like is, see, for example, it is a three-tier structure. On the top, you find the sponsorer who creates the mutual fund, right? You have trustees and you have the asset management companies, right, which oversees the fund management. So this structure has come into existence due to SEBI, because SEBI wanted to regulate the mutual fund market. So it has created the structure. Now, the first role, that is of a fund manager or a fund sponsorer. A fund sponsorer is the first layer in the three-tier mechanism of mutual funds. SEBI regulations say that the fund sponsorer, it can be any person or any organization that can set up mutual fund to earn money by fund management, right? The sponsorer, who can be a sponsorer is a person who has an experience in financial service for a minimum of 5 years, right? The net worth of the sponsorer in the last immediate year should be greater than the capital contribution. The sponsorer must show profits in at least 3 out of 5 years, last 5 years, and the sponsorer must have at least 40% of share in the net worth of asset management company, or any person who can fulfill the criteria can be named as the sponsorer of mutual fund. So he is the first tier. After sponsorer, next comes the trust and trustees. See, this is the first layer tier. Then we have something called as trust or trustees. Now, who are they? They are the participants. They are the second layer of structure of mutual funds in India, right? A trust is created by the fund sponsor. You create, as a fund sponsor, you create something called as a trust, right, in favor of trustees, right, and create a document called as trust deed. This trust is managed by the trustees and they are answerable to the investors. Now, what is their primary function is to, their primary function is to safeguard the funds and to safeguard the assets. Now, this trust works to monitor all the activities related to mutual fund and checks whether they are complying with the legal requirements of the SEBI or not. They monitor the systems, they follow the procedures, they look into the overall working of the they look into the overall working of the mutual funds. Asset management companies, they are the third layer in the structure of mutual funds. This asset management companies act as a fund manager or investment manager for the trust. That is, whenever you want to establish an asset management company, remember that asset management company is responsible for all the fund related activities. It is the one who initiates various schemes. It is the one which launches the same, right? The asset management company is expected to manage the funds and provide services to other investors also. Apart from these three layers, there are other participants involved in asset management company, like custodian. Custodian is also a participant in mutual funds. He is responsible for safekeeping of the securities of mutual funds. He is the one who collects, tracks the dividends and interest amounts that are earned on mutual funds. Apart from that, we have something called as registrars or transfer agents. These are the entities or these are the institutions who provide services to mutual funds, right? Like processing investors' application, keeping a record of investors, sending out account statements to investors, periodical report writing. Everything is done by what you call as transfer agents. Then we have something called as auditors. Auditors are also an important part of mutual funds. This auditors audit or scrutinize the books of accounts and make sure that the annual reports are prepared properly. And we also have something called as brokers, right? The asset management companies, they take up the help of the brokers in order to buy and sell the securities on the stock markets. Now, whenever we are talking about mutual fund schemes, there are a lot of mutual fund schemes, like we have growth and equity schemes, We have something called as income debt oriented schemes. We have something called as balance hybrid schemes. We have something called as money market and liquid schemes. We have something called as guild funds. We have something called as index funds, specific fund schemes, or tax saving schemes, or exchange traded funds. Now, whenever you're talking about growth and equity oriented funds, these kind of funds invest only in equity shares or equity related instruments of the company, right? They only deal with equity funds because they deliver superior returns when you compare them with the other funds. Their major focus is on capital appreciation. That's the reason they are called as growth schemes. Their major uh, work is to capitalize the market and converting them into large funds, mid cap funds, and small caps, which is very, very important. Next are income and debt oriented funds. Here the fund is invested in fixed income instruments, like you can invest them in governmental bonds, debentures, money market instruments, and things like that. Balance and hybrid schemes are the schemes where you invest in both equity and fund markets, debt markets. That is, you either invest them in small cap, mid cap funds, or you can either invest them in governmental bonds, debentures, or money market instruments. We have something called as money market or liquid schemes, where the funds are invested in liquid instruments like treasury bills, commercial papers, debt securities, which can be matured within 1 year, usually before 91 days, right? The maturity can be attained. There is something called as gilt funds. These are the funds which are invested only in bonds or fixed interest bearing securities, which are either issued by the state government or issued by the central government. Not only that, we have something called as specific funds or specific schemes, where the funds are invested only in specific or particular sectors like technology, telecommunication, fast moving consumer goods, petroleum products, and things like that. So if you are investing in gold, real estate funds, these funds can also be can also be called as specific sector funds or schemes. Then you can invest in something called as tax saving schemes. You can invest in any investment avenues where you can get deduction under 80C of Income Tax Act, right? You can get long-term appreciation and have minimum 3-year lock period. Or else you can invest in exchange traded funds. These exchange traded funds can be bought or sold on stock exchanges, right? Which have an asset value, right? Which you can invest in those kinds of funds also. And finally, you can also invest in capital protection oriented scheme, right? In capital protection oriented scheme, you invest in capitals, you invest in portfolios which can protect your capitals. That is also one of the major investment that can happen. Apart from this, process of investing in mutual funds is you can invest in mutual funds either by taking the help of agents or brokers. You can invest in mutual funds either using something called as mutual fund companies, or you can register yourself as registrar or transfer agents. You can invest through investor service centers. You can invest through fintech investment platforms. You can invest through mutual fund utilities also, right? Which is one of the important ways or process in which you can invest in mutual funds. But you need to know about credit rating. Credit rating see, whenever we are talking about credit rating, many investment opportunities or many investment options are available for people if they want to put their money or if they want to invest their money. There are a lot of investment choices. But investment is made with a desire or with an interest to get more return on investments. However, all investments are not safe, right? Because every investment avenue has its own advantages and disadvantages when it comes to investment. Therefore, we need to take the help of credit rating. Now, what is credit rating is? It is a fee-based service, right? Which will help the users such as investors, borrowers, and bankers to know whether they can invest into a particular credit organization or whether they can invest into a particular company or not. Now, what happens on the credit rating system is it is defined as an act wherein you are giving some values to credit instruments by assigning them to the solvency. That is, you are telling the, you're judging the ability of the borrower to repay the debt or expressing them through a predetermined tools. Now, whenever you're talking about the characteristics of credit rating, assessment of insurer's capacity to repay is done under credit rating. See, whomever or whichever funds you are investing, whether that borrower has that capacity to meet the financial obligations or not, right? Whether he is in a position to pay the interest and principal amount borrowed or not, that is done by credit rating agencies. Not only that, it is based on the data. It is based on the financial strength. It is based upon the financial, what do you call as, in data that is provided by the company's management. It is always expressed in simple. For example, AAA, BBB, which can be understood by the layman also. That is, if the credit rating is A, they are highly capable. If the credit rating is B, they are normally capable. And it is done by experts. Credit rating is always done by experts or reputed or accredited institutions. Only they can do the credit rating. And guidance about investment, not recommendation. They will only guide you whether you can invest into a particular instrument or not. They will not give you any kind of recommendation as to where you should invest or things like that. That is how credit rating works like. Now, whenever you're talking about credit rating, the functions of credit rating include, see, I told you it is somebody which gives you guidance but not recommendation. So it only provides you unbiased opinion to investors whether they can invest into a particular investment or not. They are not biased towards any companies. They are not biased towards any instruments while providing you the credit rating services. They provide you quality and dependable information. Whatever information the credit rating agencies give you, it is reliable, it is accurate, it is something called as precise, where they get the information which is from a trustworthy sources. It provides you information in a language which is easily understandable. See, I told you it always gives the information in simple format. This simple format of information is easily understandable. So credit rating agencies gives you information in this simple language. They provide information at a very nominal cost to the public, and sometimes free of cost also. They provide the information about the credit rating. With the information that is provided by credit rating agencies, investors can take up decisions of investing. I told you they only give you guidance. Investing is done by the investor. So whether, if they, based on the information, the investor can decide whether they can invest into a particular revenue or not. Not only that, it will help the investors in instilling discipline among the corporate borrowers. See, you are not investing in whatever investment avenue you are getting. You are investing in investment avenues which will fetch you something in return, right? Not only that, they help you in formulation of public policy on investments. Now, what are the benefits that you get out of credit rating agencies is, credit rating agencies help you, right, in benefiting the investors, benefiting the rated companies. There are some benefits to investors also. There are some benefits to rated companies also. There are some benefits to intermediaries also. Now, what are the benefits to investors is, you can get your risk assessment. Before investing in any investment, you can understand what is the risk involved into it, because it is given in the form of A, B, B. You can easily understand with the investors. The second benefit that you get is, you will get an information at minimum cost or even sometimes free of cost. You have continuous monitoring that is done by credit rating agencies. So the information that is provided by them is always accurate or reliable. And they not only give services to domestic investors, they also provide services to foreign investors. They give investment as a choice of investment, or they give investment as a choice of option. There are some benefits to the rating company also, or the rated insurance also. You can borrow at cheaper rates. You can facilitate corporate growth. You can add to the goodwill of the company, right? Not only that, you will impose a kind of financial discipline on the borrowers also. Not only that, there are some benefits to the intermediaries also. When you're talking about the benefits to the intermediaries, merchant bankers or brokers' job is done easy because of this credit rating agencies. Because if credit rating agencies are not present, merchant bankers and brokers will find it very hard to convince the investors about the financial position. Therefore, their job is done easy because of this credit rating agencies. Now, whenever you are talking about the credit rating process, the first thing that you have to do is you have to enter into an agreement with the credit rating agency, right? This credit rating agreement contains all the terms and conditions of doing the rating. After you enter into an agreement, they appoint something called as an analytical team. This team comprises of experts, right? At least two experts are identified in the relevant business area, and they carry out the rating process. The first thing that they do is they obtain the information. This analytical team obtains the information from the company's financial statements. They collect information pertaining to cash flows, financial position, what is their market share, what is their operating efficiency, and things like that. Not only that, after that, they meet the officials. If there is any information which requires further clarification, or if there is any information which requires further understanding, they meet the officials and executives to clarify that information. After that, they find discussions with the internal committee. The analytical team will sit with along with the internal company and take their opinion about the credit rating. After that, a meeting of rating committee happens, in which a few directors and the final authority for assigning ratings will be identified. And finally, whatever is the rating committee is constituted in order to communicate this rating information to the company. Then information is sent to the public through rating reports and press. If there is any issuer who has accepted the rating, or if there is any rating agency which has an obligation, the rating agency monitors all those ratings and gives a revision of rating. Now, once after the credit rating process is done, these are the agencies in India who does credit rating. You have something called as CRISIL, Credit Rating Information Services of India. You have something called as Investment Information and Credit Rating Agency of India. You have something called as Credit Analysis and Research Limited. You have Brickwork Ratings India Private Limited, India Ratings Research Private Limited, and Informatics Valuation Rating Private Limited. These are all the companies which does credit rating in India. But even after providing so many benefits, or even after providing so many resources to credit rating, there are a lot of challenges that Indian credit rating agencies face through. The first challenge is conflict of interest. See, there is no uniformity among the rating companies. There is always a conflict of interest. There is always a conflict that is happening between the rating companies. Different rating company gives different rating, right, when it comes to its services, so that there's conflict of interest. There are high entry barriers which prevent the competition, which help in protecting the interest of the investors. Rating shopping is one of the important challenge that the rating agency face. Poor quality rating is one of the biggest challenge, because of some rating agencies do not have enough of manpower to do proper rating. That will lead to poor quality rating. Independence of the rating committees. These rating committees are not supervised by anybody, so they consist of external experts which shift from agency to agency. That is one of the important challenge with the rating committee. And unwillingness of the companies to share the information. Companies don't want to share accurate information with others. Who takes up their services, they're sharing that information only with them. The others are not sharing any kind of information. So that is turning out to be the biggest challenge with the rating agencies. But despite of this inefficiencies, or despite of this challenges, this rating agencies are gaining a lot of importance, or this rating companies are gaining a lot of privileges in the present scenario of rating process. Yes, that's all for today. Thank you.
Thank you, ma'am.